Welcome.
Happy Saturday. Thank you very much for being with us for another session of our weekly market analysis. Uh, what a week it was. Again, the big talk, obviously, it's been, again, the inflation, interest rates, and of course, icing on the cake has been the geopolitical with the Ukraine and Russia situation, as well as, again, the whole Europe, really. As always, this week we're going to review the economy, the markets, our added new segment, emerging markets, the lesson of the week, the trade of the week, the screen of the week, which, as I mentioned, every week I like to come up with a new screen. So hopefully they are beneficial. So let me start with the economy. And as always, we like to look at under the hood. And one of the interesting things was that the level of the initial jobless claims came actually higher than expected. But we still, as far from the continuing jobless claims, we still actually better than where we were in 2019, just pre-pandemic. But we're getting close now. Again, remember, March is coming, so all the numbers are going to be interesting. That's why we continue comparing these things to 2019 level. Again, the employment looks strong, and there's still a lot of job openings. The question is, again, the concern is about the future of inflation, whether the Fed is ahead of the curve or behind the curve, what they're going to do. I mentioned last time, this is going to be a heavy balancing act. And you shall see that we're going to emphasize more and more, again, on the fixed income and the yields, because that is going to be the key for the equity markets as well as your pocketbooks. So I think that's important. As a matter of fact, we might have asked Jean-Claude for another class, because I think it's really important for us to understand the debt market as much as possible, and not just the treasuries. Again, we're talking about the government bonds, but also the corporate, and I'd like to even discuss more of the international, especially emerging debt equities, debt issues. So that's, I think, is a big key, and they all go hand in hand. And that's one of the reasons I really wanted to add this emerging market segment, so it gets you more familiar, because I think we will definitely need a lot of different alternatives in the environment that we are in as far as the trading and investing. So as far as next week, we have a couple of big ones that I thought to choose would be on Thursday. Remember, Monday, the US markets are closed. It's a bank holiday. This is actually President's weekend. So the stock markets will be closed, but the futures market, they open on Sunday, but they will close at 10 a.m. Pacific time. The equities, the bond markets will be closed on Monday, the grain market, but they will open on Sunday evening if you want to trade. The liquidity will be low. It will be low volume. So I would recommend, if you don't want to do anything, I would enjoy that day. Just, you can watch things, but I wouldn't trade. So we'll discuss that a little more. So what we want to look at, besides, of course, everything is pushed, by the way, for the inventory. For instance, the crude oil, which is usually on Wednesdays at 7:30, is pushed to 8 o'clock. Natural gas is always on Thursdays. And then also we have the unemployment. But this is what's important. I think the preliminary GDP, the quarter over quarter, we want to watch that, because again, we're talking about the yields. The GDP projection, it is about 2%. The Atlanta Fed is looking at 1.3%. And when we go back historically, the central bank, or the Fed, it's been very rare when GDP is below 3%. That's when they start actually tightening. So generally, when the economy is doing well and they're up above the 3%, that's when the tightening happens. So if our projection is, let's say, in a good way, 2%, and Fed is trying to tighten, that's the balancing act. And I guess, again, this is going to be a common theme for the Fed to see what they're going to do. If they push it too much, that would be recessionary. And perhaps would that be something that they want, to one way of quieting down the inflation? But if they fail, then we have the stagflation, and that would be the worst case scenario. I mean, it will be actually worst. That's what I mean. It's not a good way. So this is important to watch, that GDP number. On Friday, we have the personal consumption expenditure, which is even better than CPI. But I've said it before, I mean, both numbers are kind of manipulated, or I mean, not manipulated in a way, but they are designed to favor the numbers. And we will discuss that even more in the next segment. But it is important to watch. We got the core PCE, which excludes the volatile energy and food. So we want to watch that. I'm gonna, again, emphasis will be, and you can see it, not just United States, but internationally, all eyes are in inflation. We have really gotten spoiled, especially for a younger generation. For some of you who've been around maybe for 20 years or so, or watching the markets for 20 years, we've really, especially in the last 10 years, we haven't seen any type of inflation. So it has been pretty comfortable. And that's the reason Fed was, doing whatever they were doing, easing money and, not to worry, but everything has a consequence. So I thought this was really interesting chart, a graph to look at, that this goes back March of 2013. And we look at from there till right before February and 2020. For 86 months, the inflation was up 10.2%, not cumulative, I mean, not annualized, it was cumulative. It went from, again, when we look at the percentages, let's say from 255 to 228, that was about 10.2%. And right after pandemics, this is what we have done in 21 months. So that's the severity of where we stand right now. And again, we're not used to seeing this. And that's the reason there's a concern. Still, there is a camp saying that this is transitory with the supply chain, opening up, the economy is opening up. But this is the fact, and this is where we are looking at. Another chart I want to share, and this is, I want to, as you know, I just love history, so we want to go back. So this is a graph from 1947 to January 2022. It's the last numbers we've had. So cumulatively, the inflation has gone up 1,261%. So what that means is, if you were making $100, that would be equivalent to $1,261 in today's dollars. And when you average it out annually, again, this is not a true way of doing things, because there are years, decades that we were below that, and then there are decades we were above that, like 1970s. But we just average it out, and that becomes 3.44%, which is this red line, as you can see, representing what we've done. So these bars represent the 12 months rolls. So for every bar is a monthly compared to 12-month total inflation, where we've been. And you can see, I mean, just visually, when you look at what happened end of 1960s, this was the high inflation. If you recall, we had the OPEC crisis. This is coincides with when we did, or Nixon decided to uh, undo the gold as a standard. Gold got away with the gold standards, and basically got away from the fixed currency. So basically, this was 1970s and beginning of 1980s. And again, I remember those days very well. But look at what has happened since then. We've been in pretty low inflation environment, and this is where we are now. So that's, again, it just gives you a concern because we are way above, and we are going back close to 1970s and where we were. And again, the number came at 7.5%. So the other thing, as I mentioned, we are already, again, the GDP needs to really grow if there's going to be an increased tightening of the interest rates. This is going back to since the right pre-pandemic. So this is also, the last one came in January, as recalled. So we compare January of 2022 compared to January of 2021. So I'm playing a devil's advocate here now. We're talking about there was 7.5% compared to 2021. Remember, when we go back to that, of course, there was no inflation, so the numbers came higher than, because they were comparing to when we talk about March and April compared to pre-pandemic, I mean, to right after pandemic, so it was high numbers. The question you have to ask now, after March, now we're going to have April and May, and then we're going to compute the numbers in April, May, June to 2021. At that time, the inflation numbers comparing to the previous year, it was already at 5.5%. So again, from the talking about devil's advocate, and the perception is now when April and May comes, now we are comparing the inflation to like 5.5%. So there's a chance that there's a good chance it's going to look much better. So we look at, inflation is about 2% higher. How would Fed react to that? Are they going to take advantage of these number playing and say, oh, maybe we shouldn't tighten as much? Or I think the biggest tool is the balance sheet, and that's when they start liquidating and reducing the balance sheet. Would they say, well, maybe we should slow down, we shouldn't do that? So that's one thing for next 3 months, I think is very crucial. And that's one of the reasons when last week on Wednesday, when the minutes came, the markets had a kind of a relief rally at that time, because it didn't sound as hawkish. And it seems like the markets are not going back to that 25 basis point, but they're resigned to thinking that they might be 4 or 5. But I think the more important thing is that balance sheet is even more important than increasing the rates. So that's, again, I want to share that with you. This came from Twitter, from Epsilon Theory, and I just want to share this with you, what they are saying. And again, I'm going to play devil's advocate, okay? So the PPI numbers came, and it was higher than even CPI number. And PPI numbers are the producer's price index. These are the real, these are the business who have to get the raw material. They have to import things. They have to, they are in the know what's going on. And of course, they still haven't shown that the pricing effect of it, they're going to increase the prices. So there's still more to come, putting pressure on the CPI side. So there is zero reason to think inflation slows over the next 12 months, as every economic actor in the world is now laser focused on raising prices for their goods, labor, or services. And PPI in US running at 10% year over year, accelerating month over month. Inflation gets worse from here, not better. So yes, the PPI numbers came, very high, and of course, that's going to have a large effect on CPI. The other side is that, the companies still have other tools. I would use the technology, but they still might bring their profit margins lower, just maybe because of the competition, and especially if there's an opening of, again, with the supply chain. Imagine what happens with the cars and mass production, then that might affect things. So there's still some room for them to finagle and maneuver, I should say. So, but this is, again, the reality. This is where we stand. So just want to watch both sides of things. So let's talk about the markets. Now, the markets was really consumed, especially the last 2 days of the week, and you could see what happened to we shall see what happened to the markets. It was a lot of emotions. We've been in a very much event-driven, and basically it was all about Russia, Ukraine, and then obviously also Friday was option expiration, which had $2.2 trillion of options expiring on Friday. So there's been a lot of hedging going on. And the reason I want to bring that subject as far as the Russian situation, it is very fluid. And it's an interesting fact. Again, President Biden came on Friday, 150,000, actually about 190,000 troops. They're not on vacation, so they have a purpose. So there is a good chance things could happen. I think last week we talked about the only way could be maybe Ukraine changes their constitution and say they're not going to be part of NATO. But it seems like it's given. And if I was an investor or trader, that's one of the reasons I wouldn't go home, especially in a long weekend, holding equities or any type of at least a trade, because things could happen. Now, I have a theory. If it's going to happen, perhaps Putin will wait till the Beijing Olympic ends, so will not take the spotlight. I mean, just an idea. So the 20th, which is tomorrow, is the last day of Olympics. So maybe that's what market is waiting for. After that, he will do something. And of course, there's two separatist groups. I mean, the two of the parts of Ukraine are already, they want to be separated from Ukraine, and they've been fighting the Ukrainian military, and then Russia could use that as an excuse. But anyway, just a theory again I have, maybe it could happen after the 20th. And I want to bring that subject again, this sentiment. Again, people are very, I've mentioned about the recent things oriented. They're not even looking at very long term. So you can see how our bullish side has been going down, and we are like at 50% of the average, of historical average. And our, as far as the bearishness, which is at 30 and a half, almost 45% above. So there's a lot of bearishness. There's a lot of hold because there's still positiveness that things could, after the second half of the year, things might get normalized. But this is very fluid. So not long ago, this was like a Christmas time, you could see how the numbers were up, this was down, and how things are just moving back and forth. The same thing with fear and greed. We stuck actually this fear at 37. This is the interesting things that I hadn't seen in a long time, and it keeps going down. So the Citigroup panic and euphoria keeps going down. So we're getting close to that panic. One of the things, again, these are very fluid in a sense that there's just so much news out there that people actually become reactive rather than take a lot of things into consideration. So that's why it changes from week to week. It's interesting to observe them. I would use these at really extremes for any type of reversal or any fading. So, but yeah, I mean, it's interesting how the sentiment can change so quickly. So this is what happened last week. I mean, Tuesday and Wednesday it was nice, and then all of a sudden, Thursday and Friday, we had these big drops. You can see negatives everywhere. Transportation was really the only one flat, but even Dow Jones Industrial and S&P, and then we had NASDAQ, we had Russell, which was, it was did perform better the previous week, but everything is down except, and then S&P small cap was also 0.25, mid cap was 0.57, but all the markets are down pretty much obviously for the year. So this is telling us there's a lot of pressure. Once we look at the charts, we'll see more. The other thing is, again, our advanced decline line was weaker than the previous week, and our new highs now is 127, new highs to new lows. So of course, again, I would say we look for the extreme, so we want to watch that. And what happened with the dollar? Dollar was flat, and there's a couple of reasons. So obviously, the dollar is the sanctuary. It's in this situation is a risk on, and that's they want to make sure that because of what's going on. But other than that, the dollar is also considering if there's going to be too many interest rates going up, that could be dangerous for the economy. That would be slowed down. So that's negative for dollar. So again, another balancing act. And that will translate to the financials too. So, and I've said it, the financials are the key for S&P. Technology has already been going down, and financials and energy have been holding the S&P up. But if that goes, if the financial goes, we still got more rough ride ahead. The T-bonds, you can see they had a nice ending to the week. Again, flight to safety. So that was the main reason. And then crude oil, naturally, it should have been higher. Again, it's almost inevitable that there could be something going on, but towards the end of the week, we had the Iran situation. All the parties seems like they're coming to agreement that there could be a good chance that sanctions could be lifted, and based on that, there will be more supply of crude oil, so the prices did go down. Inflation was just flat, and the gold obviously had a very nice day, especially after the news of again with the UN and the NATO secretary saying that it looks like things are going to happen. So gold had a nice, and it's in a crucial point. We'll discuss that. As you can see from high to low, the Dow Jones has been the strongest of all the indices, but down 7.34%. S&P is close to that 10% correction from the high of January 4th. And then NASDAQ is already in the correction. It's down 14.5%. Oil this week was one of the few weeks we were actually down. So it's down 4.6%, but up 19% from its low. And basically, that's that. So let's go back to the yields. Again, I want to emphasize that's what you want to study. You want to be very familiar with it. The short-term rates, the dollar, it dropped a little bit again. What was happening? There was that concern that there could be a 50 basis point. There was a closed door Fed meeting. Obviously, Bullard came, and he's still hawkish. But on the other hand, you can see the UK's still continuing the short-term rates. There's a chance that they're going to increase another 0.25% because the inflation number came again higher than the highest in 30 years or so. This yield curve, please watch this. And this is comparing where we were in 2021, exactly a year ago. And this is where we are. This is where we are. I'm sorry. Yeah, exactly a year ago. This is where we were a month ago. and this is where we are now. And I will go more in details. One thing you want to take a look at from 3 months, look at the slope to 2 years, 2 years to 5 years. What happens from 5 to 10 and from 10 to 30? So you see the acceleration is the slope is going up in a much reduced acceleration, and the slope is kind of getting flatter and flatter. So the same thing we can see again as far as the long-term bonds. There was flight to safety, and the LIBOR also went down a little bit, but the high yield is still there, and the corporate bonds are right above 3%. With that in mind, I want to bring this. This is from Peter Brocker used Bloomberg, and I want to show you what is happening from very short term. Look at the slope from the short term, and when we get to 5 years, this is steep, and this is what you want to concern with the financials and what's happening there. What happens from 7-year to 10-year now becoming flatter, and then from 10-year to 20-year we have a little slope, but from 20 to 30 we actually having a little bit of it. It's flat to inverted, and this is a question mark for the Fed. How are they going to have this balancing act, and what is going to happen without really disrupting and creating recession? One of the things also for inflation, there could be there's a possibility that on the side that people who thinks there could be transitory, they feel again the supply chain will open up, and they think, oh, there might be another COVID. Oh, another COVID, that will take care of all the inflation in some ways. They think it's going to be recessionary, you know. So there's that. I don't know if it's a hope or it's just an idea, but that's one thing. But right now, this is, we want to watch that. So let's talk about the markets. This is, again, I'm looking at how the markets basically reacted. You see, we went ahead against the 61.8 from the high of right after Christmas, right before January start, to the low of, I believe, January 24th. Yeah. So basically, this is the Fibonacci. We spent a lot of time in the ambush zone. We went, hit the 61.8, got rejected, tried it again, got rejected. This is the 2 spot, and it looks like a double top. While we're talking about double top, the way I like to see it and the way it works, there's a double bottom or the double top, whether you're using hourly, whether you're using 5 minutes. These double tops and the classical or the classic technical analysis, in my opinion, they work much better in the longer term time frames. So they're much better in a daily, weekly. It's visually, they're more visible. So when you translate to 5 minutes, it works and it's good, but the real class comes from the daily, for instance. So on a daily, what I like to see on a double top, I like to see actually lower on a closing basis. I like to see lower close than the previous top. And the second rule will be, I like to see a lower volume to confirm that this is either real double top or is a double bottom. And the reason for being is that means that there is no buyers or no sellers. So usually you'd like to have a higher volume in the beginning. That means the buyers are enthused, really enthusiastically want to buy, or the sellers are, oh, this is it. This is the biggest bear market. We're going to sell everything. And when it bounces, the second wave is already discouraged. So whether they're selling or whether they're buying, and this happens on your head and shoulder, for instance, on the left shoulder is a higher volume. The right shoulder is usually, we like to see it with descending volume. So the same thing with the double top. I mean, this was a confirmation for me. That's why I want to put these lines. You see, we had volume was not very high, but still was there. But the second volume is actually lower than this volume. So that gave me, that could have been another reason to watch 61.8. I know we discussed this when this happened that week. And then we were going against the 50-day moving average. So there was a lot in hand. So where do we stand? We need to hold this 23.8, 23.6 actually. And if we don't, the magnet, it looks like the ultimate thing will be that 4,200 low that we hit in January. So which actually corresponds all the way to September when we had that low, or October 4th actually was somewhere. Yeah, October 4th, we hit that low. So you see how big of a support that is, but it looks like it's the magnet is tracting. If we hold this, the 4,400, and we discussed 4,400, then 4,500 are the big resistance. So if we hold that, go back to 4,400 and go up, then that could be positive in the short term. If not, that's the magnet for me. The same thing when we come to Bollinger Bands, we see how going back, just this level, we already discussed the Fibonacci, we discussed the 50-day moving average, we discussed the double top with the low volume, and here, this is our 100-day moving average, and another rejection. And now the support goes back again, as I mentioned, goes back where it was. The Bollinger Bands are close. We've already, the momentum is down. We are not in the oversold yet. The MACD has crossed. It's been pretty noisy. So that is more pressure to the downside. NASDAQ has been actually the biggest of all the indexes been affected because of, again, the technology sector, and it's already sitting right now on that support zone. So it is at 14,000 is a huge level. So we want to watch that. Otherwise, it will go to 13.5 and eventually will hit the 12.5. So it got rejected at the resistance. It's way below its 100-day moving average, and we could not hold. That's above 18. Again, that's the reason I like to use the 2 candle confirmation, especially on a daily, things like this. So it keeps you out of trouble. So now that 18-day moving average has become your resistance. Going to go a little quicker. The Russell, the same thing. It held its above and looked good. It was for a while, and then hit that Bollinger Band. So we shall see. It was overbought, as you can see. MACD is still on, trend is up, but momentum is down. And we just broke below that 18-day. We could not hold above that 18-day. YM has been the strongest. Now, take a look at this. This YM going back to May. I mean, basically, we've been, except this area, it's been pretty range bound, but it's been the stronger, and we broke down to, again, with the 100-day moving average. In this situation, second bar, and now getting close to that support, which we hit in October again. So watch that. The momentum is going down. We are not oversold yet. MACD is going down. Transportation actually was the best one for the week, but they already been damaged in the sense they're still under 100-day and below the 18-day. The momentum is down, and the MACD is flat. The VIX, I will discuss VIX a little, I think, in the lesson of the week a little more, but the VIX, we discussed last time, I think we were talking about, the VVIX was telling us we are not out of woods, and this thing has been above this threshold, that 100-day moving average, nicely. Now we are above the 18-day, which doesn't bode well for the markets as a whole. And of course, you can understand, again, we have a lot, we have the geopolitical situation, and we have a lot of uncertainty regarding the economy as a whole. And VVIX has been holding above. Look how many times we hit that 100-day, and we've been keeping above that. We are nowhere close to Bollinger Bands, although closing in. And then 10-year yield. Remember, we hit that 2.03, 2.05, hit the Bollinger Band, came back, and now we were embedded. Now we are overbought, so we are getting close to that 18-day moving average. So watch for that. After hitting that, would that mean that we will bounce back, or will this continue going down, the MACD's crossing, which bodes well for the bonds? But this was more of a reaction, as I mentioned, for this, again, the safety move. And the same thing, the opposite with the 10-year note, we are getting back to that 18-day moving average with getting out of embedded and becoming oversold, plus the MACD's crossing. So again, perhaps this saga continues because of this geopolitical situation. Now, if I've said it before, that 2% is a big threshold, and that's important. If we break that and continue, then there will be a lot of question on the consumer side, in my opinion. People who have a big items to buy, people including the houses, the cars, now they don't want to lose that opportunity, so they will, that could be an effect, and that could be a self-fulfilling from the inflation point of view. So you want to put all the different pieces together from that point of view. And the financials, as you could see, actually had a nice run, but since then we hit that Bollinger Band, and we're trying to hold. So this is very important. We are right around the 118-day, and that's what it's important to see whether we can hold it, because if we break down and this becomes a double top, that definitely will affect the S&P. The dollar has been steady, and basically, as I mentioned, from the geopolitical side, it should have been strong. But again, the fear of having multiple interest rate increases up to 7, that keeps it on hold. Now, of course, if you break this area of 97 change, then all bets are off. But right now, we're just behaving in a very subdued manner. What a day gold had, the 2 days on Thursday, and it was a difficult trade for me. I didn't make money on Thursday, our gold trade. I got in at the okay time, but there was so much resistance, and I already had a big move. So basically, this was that Thursday move, and then Friday. So it didn't. Friday was a doji. So basically, the question is, can we break this big resistance at 1921? We are outside the Bollinger Band, and 1900 is a big resistance. So we are not embedded yet. So we're getting very close. So we want to see, would that retrace back and then move up? Because once we break this 1920, it's 1983, and then we passed the 2000. So this is important. But again, was more of a geopolitical side and less of, in my opinion, of inflation. From gold to silver, you see there's a little divergence in the sense that the silver didn't have the same amount of move. When we look at we still haven't gotten close to where we were in November. And of course, silver follows gold up to a limit. But if there's a geopolitical trouble, it affects the world economy. And with the world economy, there goes again the trades, and as far as the manufacturing, it's needed. So silver did not react as much as gold. But you go back to this big support that we've had for, I would say, years, and you see every time we have broken below it, we always bounced back. So this has been a good level for either doing credit put spread or doing a debit call in that area, or even naked put if you wanted to go really in speculation. Um, uh, the volatility is really narrowing on the copper. Copper is important, so I would watch this. Very much dependent now that Olympics are over or will be over tomorrow in China. It's very much dependent on the Chinese, the zero tolerance policies, what's happening in with the geopolitical, but also the supply chain. And this is interesting because if it gets going, I mean, this can really unravel and could go up. So right now, I see it's coiling. So we shall see what happens. Again, it's more of a China play, in my opinion. Bitcoin tried its best. We had a nice bounce from its weekly moving average of 100 weekly move, went to that right to that Bollinger Band. And we became embedded for 3 days. And then the 4th day, we just could not hold and we sold off. Momentum is down. We did hit that 18 and we broke down. So MACD is still positive, but it's very close to the sell signal. Crude oil, as I mentioned to you, it's been a beautiful move outside Bollinger Band, came back in right to that 18-day moving average. It was overbought. Now we are getting to neutral zone, but as I mentioned, it's more of a Iran play in that. And energy, the same thing. Energy, that was, I think, the first week we were down. I mean, oil was the first time this year had been down for the week. And I want to finish with this. This is corn, and it has had a beautiful move, gradual move, has its own mind. You can see it's been a big move right on, above its 18-day moving average. And within, we have the soybean story. Again, depending on China with the soybean crush, what they're going to do, but also it's very much a weather in South America. So we are watching that, and that's one of the reasons soybean and corn, they have been reacting very nicely. All right, the expected move, it was really interesting week because S&P, stayed inside, never touched any of its edges. And, here we go. It was Tuesday and Wednesday, nicely done. And, the minutes came, we had a nice bounce. And then Thursday and Friday happened, just wiped it up. But we stayed very much contained. So for this week, remember, we have a 4-day week. So basically it is a shorter week. We have 100, it was 135 last week. This week will be about 110 or 113. So it's going to be a little shorter, smaller, although it's a 4-day week. So watch for that. But it was very much contained. But so there's a lot of energies being built. So there's a lot of events coming up, especially Monday being really close in the United States, although the futures are open and other international markets are open. But it's a big one, of course, New York Stock Exchange, you wanted to be open. So watch for Tuesday. And then NASDAQ, QQQ, the same thing. We stayed very much without touching our edges. And again, similar pattern. Russell had a nice move, again, came close to that, but similar thing as the other one. Dow Jones came the closest, and it had the reversal on Wednesday, and we came very close to touching the lower edge. And then the bonds, on the other hand, they had gone outside, and of course they came back inside, and they had again, this is complete. You can see how completely opposite of the equity markets they behaved. And gold, the same thing. Gold actually did go, and that's why it was difficult. Thursday was a difficult gold trade for me. And although I came very close to hit my 25% target, it came at like 22% and then reversed. So anyway, so and then Friday, because of Theta, it didn't, although it was still up, it didn't, go to that, to profit zone. So silver, very orderly, and but there's a common theme, right? Besides the gold, everything else has been within their range without touching. XLF was right in the middle, and what happened on Friday touched its lower edge and respected that. And energy the same, they've been strong. So this is, again, these two you want to watch. It respected and went outside and came back and closed inside, but that's the low. Both of these, they finished on the lower edge of the expected move. All right, so let's discuss some about emerging markets and some of the latest news. Talking about Russia, I thought this was really interesting. A survey was done with the citizens of the different countries in regards to Russia and what do they feel about military and economic side of things. So we find something interesting in this little graph. It's so we have the X bar and Y bar, and then to the above that, the quadrant. This is the surveyors. They said, well, they would like to have be military cooperative with Russia. This, on the other hand, they want to oppose military. Again, the X. Let me look at the X. And in this category, you have Japan, US, Canada, and UK. Also, when we talk looking at the from the economic, so this quadrant is economically opposed and military opposed, so both. The harshest is these four countries. When you go to the third quadrant, they don't want to cooperate with on a military basis, but they don't want to oppose it either, and they don't think economically should be, be opposed. They should be cooperative economically. So they don't want to cooperate military, but they think economically they should cooperate, and they don't oppose military-wise. So China, it's given, you can understand that. But the interesting thing was India. So Indian surveyors, they said they will oppose any type of economic or military, and the South Africa also. And when you come to this quadrant, these are the countries that they oppose military, and it makes sense now. You can see they're all Western Europeans, the Eurozone, because they have economic interest, but they don't mind economically basically oppose, but they don't like to as far as I mean, they would rather, as I mentioned, they would rather, they don't want to oppose militarily, but they would do it economically. So basically, that was really interesting. So that's, again, they don't want to use the military. Turkish central bank holds rate at 14%. Despite inflation surge. Now, here is, we talk about this, of course, President Erdogan, he actually lowered the interest rates last year, pressured the central bank. And this is a country that needs to raise it, but no, they've kept it at 14%. And, the inflation jumped nearly 50% in past year. And if you recall, in September, we talked about they 500 basis point, they have cut the interest rates because of President Erdogan had said it. And the lira, on the other hand, this past week is around 13.62. So last year was a horrendous year for Turkey's markets, including the lira that was down 44%. So basically that's, we're looking at some other countries. Some of them have increased, some of them are holding tight, but the inflation is not as high as, let's say, Turkey. So the other thing was just looking back, some of the strongest markets last year, and some of the markets were doing better this year. Now, the big winner was, I think we reviewed it in our emerging market or our returns, was Saudi Arabia. And for 12 months, they're up 40.8. And the year to date, they're up 11%. Only Brazil, which has been up, and a lot of Latin American countries, they've been up year to date. And we discussed that, I think, in the beginning of January. So besides that, Mexico, 12 months return 21%, Taiwan 19, South Africa is 15.6, India 14.7, Russia 8.4, Thailand 6.4, and then we go to Hong Kong and Korea in the negative. So just interesting, watch Saudi Arabia. The next one is we've discussed about why we have this flavor of emerging markets, because if we are going to be in the commodity cycle, especially super cycle, that's going to affect very much many of the emerging countries with a lot of natural resources. So we want to look at, because they're exporters, and obviously that helps their GDP. So based on agriculture, fuel, and metals, what percentage of GDP it affects them. Now, there's an exception, and it's very important. That's why I want to share that corn with you, between corn, wheat, rough rice, between, we talk about soybeans. Now, we talk about revolutions have happened because of high prices of grains, especially, let's say, wheat. So the countries, you want to take this into consideration. So that's what you want to look at as a blanket when you say, oh, commodities up, so this country is going to go up. Countries like Bangladesh or Jordan, Lebanon, and Pakistan and Philippines they're excluded from this high commodity related explosion, because the high food and crude oil prices, they're importers. So it affects them much, much worse than other countries. So that's why we take that with, just got to be careful with that. But again, you can see some of the countries that we've broken down: large, emerging, developed, Africa, Asia, Europe, Latin America, Middle East. You see the Saudis in the large emerging, and how that gets help, obviously, because of oil. And Russia, well, I'm sure they're enjoying this high crude oil prices and the natural gas and corn and wheat. South Africa, Brazil, South Korea, India, and China. I remember, like China, India very much is an oil importer, so has to rely on other commodities. Then developed countries, we have Canada, obviously, again, natural resources. And US is although we are the largest, we were, exporter of crude oil, not anymore. The US is 2.1. Then we go to Africa. And again, there's the metal side of things, and also some countries, they actually, when we think about Nigeria, we think about Libya, Angola, for instance, they have crude oil, and of course, all the mining companies. So we look at that. And then in Asia, we have Singapore, Malaysia, Vietnam, Thailand, Indonesia, Sri Lanka, and then Central Asia, and basically part of Central Asia and Europe, Kazakhstan being one of them. They're dependent. And then South America, very much so. And again, the miners, and then we have the Middle East, again, oil, crude oil, natural gas. So that's just a little tidbit. All right, that's for emerging markets. So let's move on to a few quick lessons of the week. I thought if you'd like to have this is just for the rest of the year. So you can, rest of 3 years, sorry, for 3 years, you'll know what our vacation, our holidays are. So we had Martin Luther King already. So Washington's birthday is Monday. Then the next holiday will be Friday the 15th. That's Good Friday. So just a tidbit, maybe you can take a picture of it if you want to know. This one, we talked about Russia, Ukraine. I took a picture of this on Thursday, as you can see, right after the market was closed. Again, I want to see harmony, risk on, risk off. So all the, risk off asset classes, you can see very nicely, they were all in red. This is how the markets reacted. This was the worst day so far for the S&P 500. They were down 2.1%. On the other hand, the risk averse, where the risk is on, is there was VIX, and we go to precious metals, gold, and then grains are neutral. They have their own world, so that you can see the wheat and rough rice. But you see also the bonds, they were safe haven. Then you come to currencies, you see the dollar, yen, and Swiss franc. They also did well. Now, British pound, it was kind of flat, but they were against the Europe, and also because they've been increasing their rates, so they were more favorable. So this, I thought, it's good once, a day or twice a day. I will look at it first thing in the morning, and at the end of the day, I want to see if the assets are in harmony. Okay. The next thing I talked about the VIX. So everybody, you look at the VIX, what is happening. We look at the charts. I would again recommend once in a while, if you like, go take a look at the VIX futures, which is actually traded a lot more. I mean, people think about ETF. And what I'm looking at the March, April, and May, and the green ones, right? So what you will notice that the most recent price is higher than the next and higher than the next. So in commodity derivatives market, we call this backwardation. And backwardation, what it tells us, there's more demand for the most recent or spot price than the futures. So what that means is when you think about VIX, for instance, that means there's nervousness and people are willing to buy the closest VIX. You have contango. Contango is when the prices and the future are more expensive than today. There's not as much demand today, so naturally the prices go up because of the time, the storage, and all the other things. So this tells us the volatility is higher. So that's what you want to watch, and there's nervousness in the near term. So that's just another thing for the that's what's backwardation. This really piqued my interest. Last week, actually, the CBOE is planning to have their SPX trading for the options going 5 days a week. Wouldn't that be great? Especially if you do your chuck trade or you're doing your gap trade and you don't want to do futures. So this is in works. So they have to get approved. So they're looking at second or third quarter. So just be aware of that. And obviously the subject to regulatory review, but it's going to be amazing. I mean, there's a lot of trades done in the SPX. So watch for that. So I just want to share that with you. The next, talking about inflation, the rents, it's amazing. They say the rents were up like 3.4%, which is, there's no way. That's when you look at the CPI, that's the numbers they look at. But an average, when you look at the, looking at the communities as far as the cities, it's been up about 13.3%. But I thought, let's take a look at in 2021, the highest rents were mostly in Florida, and from Naples to Sarasota and West Palm Beach, Fort Myers, a lot in the west coast of Florida, from 38% and in Austin, Texas, to 23%. So um, you can see how many um, Florida it's there. So just a little, again, tidbit about inflation. The last but not least, I just want to share something I had found out. I talked to my kids about it, and in my opinion, again, that's my thing. People show their true character when they have too much power, too much money, and when they are really desperate. And you see that in politicians, you see in the rules. People who are good, they become even better. People are bad, they become even worse. And what does that mean to us? I think, in your trading, that's what you want to make sure you're balanced. And, if you think you're invincible, you have the power of, you think you have all the greatest indicators, you can never fail. And, this invincibility lets you take big risks and you become greedy. The same thing when you have that money, you have big accounts now. You need to come to your own, who you were, and stay with that. So make sure you have discipline. And also, I mentioned the desperation. Sometimes we do crazy things, and it could be fear, it could be missing something. Let's say we had many losing trades, and we just want to continue because we want to get back, and we are desperate because we lost money, or we want to break even, and we've had a bad day somewhere and we just want to do something. Please get away from that. We have that 3 losing in a row rule, the trading rule. Just walk away. So this was more of a general things, but I want to apply it to our trading and investment community. I want to add one more from one of my heroes, John Templeton. And he said the self-improvement comes mainly from trying to help others. And our community is that way. And I think we learn a lot more about ourselves by helping others. And I know quite a few of you, how generous you've been with your time, with your knowledge. And that's the true, in my opinion. And again, it's just wonderful to hear from John Temple. That's self-improvement. That's what the good, personality, that's what the growth is. It's not about listening to Tony Robbins or, Proctor, or, any of these gurus that they tell you. It's great to tell others what to do when you're not in their situation, but helping them and sharing what you know, that's the key. And anyway, so that's my lesson of the week. I finish with that. Trade of the week is going to be short. I want to pay attention again to these moving averages. And once we break down, and I watch, I think, about 8 of them, that when you look at, this thick lines is the big one. So the yellow one is the 50, then I have 65, and I have 100 and 200. I mean, take a look at NASDAQ. If I don't say anything about this, you don't know what market this is, what stock this is. You should ask yourself, would I buy this? Just by looking at the shape of it. So again, there's been a lot of damage done. I think we discussed about, once we saw these big bars, it was after November, this was indecision, and we said, we like to have these. And so this is something you have to be really watchful. And as I mentioned, we're getting very close to this big support. It goes all the way back to October, actually. Yeah, this is NASDAQ. So it goes back, we are at 14,000 area. Under that, that's important. So we shall see, is there going to be a double bottom? On a closing basis, we are very close to that low of January. We had a lot of wicks, but if you break down, this is not going to look good. So please watch the charts. The other one is, I was watching the SPX cash. This is the 60 minutes with the moving averages. And this was on Thursday. And Um, actually, no, this was on, yeah, Thursday. So I saw it like on Tuesday, on Wednesday. Where did we go? We went right to the 165 moving average. And basically, two candle bars, this is 60 minutes, got rejected. And the next day, that's when we had the news came out, and the UN security and the NATO, they're talking about Russia, and we gapped out. We never went back to that. So this I want to share with you, that this Thursday and this is Friday. So respect these moving averages. And this was on 16 minutes. Next, I want to talk about from the trading point of view. This is, I observed this. These are ticks, the 5-minute ticks. This is the ESD, which is the daily S&P futures. I noticed this. So what this looked like to me, and I highlighted it. It's looked like a, call it rounding top or inverted saucer, and they come very rarely, but they're good indicators for if you want to do a trade. But they're even better, in my opinion, in investing on a daily or weekly. They are wonderful, because on a daily, especially let's say daily, you see something like this. The opposite is actually even better. When you have a saucer or rounding bottom, that shows a lot of accumulation. A lot of institutions cannot buy things to create big bars with the amount of money that they have. So they have to do this matter of 6 months, matter of a year, when they like something. So sometimes you see there's a lot of patience and very narrow range. And those are great when there's a breakout, especially in a high volume. And I, let's say, quote Peter Lynch, he finds these 10Xs. You find some of great ones. Now, this was only on 5 minutes, so it was just an observation I had, but I wanted to share that with you. So this is how the rounding top looks like. And there's right in the middle, usually the top, and it's pretty visible when you see it. And again, that tells you there is something. This case was a lot of distributions happening. So I will watch the volume too. All right. Quickly, we go to the ETF of the week. I thought with all the Russian news, why don't we look at the Russia's ETF? It's a pretty large, and again, historically, you hear about a lot of value. The CAPE, the PE ratio, is very attractive, but very much related to what's going on in Russia. And so you can see there was hope. There was German chancellor, and they talking to a Russian president, and Putin, and then the news comes, boom. Now, but one of the things you have to realize, this is average of that day, yesterday, there was 10.8 million. So this is pretty liquid, and there's options on it. You see these things. The reason is that again, there's a currency risk there, or the exchange. So that's why you have to be careful with the gap plays, with the any type of ADRs or the foreign plays. So just make sure you watch that. But you would look at this and say, oh my God, this is a penny stock, or it's like maybe 10,000 volume. No, there's 10.8 million volume. But watch this. This looks like a wedge, almost trying to become an even diamond. But so if you want to play Russia, and you think that, once things come, if things get settled, they will be a benefactor, especially if there's a sanctions going away, and or there's a compromise and they don't invade. So I thought to look at Russia. On top of that, this is the 5-year chart of USD against ruble. It's important to watch, look what has happened to ruble. It's been a lot of pressure in Russian economy. So just by looking at ruble, now you see that could be a good excuse to invade somewhere to get distracted, or again, increase again the oil prices, because they're currency has been damaged. I mean, it could even get worse, but there's a lot of desperation. Let's put it that way. So Putin, I don't know if he's calculating the right way, if he thinks this is one of the ways maybe negotiate to get the sanctions lifted. I don't know. But you can see visually how much of a pressure has been on Russian ruble. So maybe this is one of the ways to bring the parties to the table. And the parties are not united. As you know, Europe, the NATO, they're not all in the same camp. And that's why I want to share that survey. So here it is, some of their biggest holdings. It's obviously majority is in Russia, 78%. But I don't know if you knew, there's a lot of money in Cyprus. It used to be the biggest one of the, people go to Switzerland. A lot of Russian investments and cash went to Cyprus. And of course, in 2008 debacle, they lost a lot of money. But you can see that there's some money in the United States. And that's what some of the holdings. Netherlands is Yatnex. It's like internet kind of a server. And that's in Netherlands, but it's a Russian company. And so that's as far as the top 10 countries, and these are some of their, we've talked about the Sberbank, for instance, in the past, and then a lot of energy, obviously, right? So you see Tatneft, Rosneft. By the way, Neft, N-E-F-T, that means crude oil or oil in Russian and some other languages too. So that's what you see, a lot of companies with Neft in them. So that's the Russia. The second ETF, I want to add another ETF. With all the talk of inflation, there's few ETFs are coming to the picture now. There are going to be a lot more. This is from Amplify, it doesn't say it there, but that's the newest one, came in December. And basically what it does is supposed to protect against inflation. So the holdings, you see for like year to date, it's up 5.32%, but the volume is, 50,000, average is 60,000, 66,000. There's no options on it. But it is, this is the explanation. And basically their goal is to protect you and have a long-term capital appreciation, but it is benefits from inflationary environment. And no surprises, these are the top 5 holdings, and they're all oil and energy related, okay? The stock of the week, I want to share something I shared with you on January 29th, market analysis. If you go back, look at our trade of the week, I had suggested take a look at this company is Sabre, S-A-B-R. They are in information technology. They're like a software company for travel agencies or traveling. It's a traveling software agent company. And what attracted me to this issue was I saw unusual option activity. And again, if you go back and watch the January 29th, I'll probably explain a little more. But in just a short sentences, I should say, there was unusual, there was with the open interest of 422, and that was at the strike price of 9, there was like a new 3,321 new volume came in. They had a earnings coming on February 16th. So I could understand something is happening. Was this February 18th was right after the earnings. So, but then I noticed also for March, there was like 10,796 volume with open interest of 12. Now I'm looking at, does this a spread? Is this something? And I noticed, there was a 5,362, but it wasn't 10,000. So it might have been part of it spread. So that really piqued my interest. So we fast forward to today, or I mean yesterday's close. So if you go back to the 9, it was priced at, let's say, the mid range would be about, let's say, 50 cents for the February. And this is what the price for this is, about 255. So, it's almost 5 times appreciation. And you see how the open interest is still there, 47.16. And that's, yes, sir, I'm sure that that was all either maybe rolled, because the March, there was a lot of activity at what? At 10. And let's say what, 48 cents. And this 10, we had 13,000, and from 48 cents to $1.85, we still got more time left on this. What interested me also, there's on 11, because I didn't watch it in between, as far as this open interest, there was like 49,892 open interest just on 11. So if you recall, again, the price of that stock was at 864 when we discussed that, and we closed at 1152 on Friday. And this is where we discussed this right here when I was noticing it. Nice channel. And every time we went down there, we got rejected. So that would have been good. And this is the earnings breakout. So they had a nice move, and they closed. I mean, everything was down yesterday, but just for the week, they were up for 25%. And this is the chart again. So they just had a nice run. So just a food for thought. Watch those unusual option activities. All right, well, we got about 5 minutes to go. Let me tell you the squeeze. This time I decided with the squeeze, let's do ETFs, because I think you have better chance of looking at the big market rather than just individual stocks. So there's a wide variety of things, so whether up or down. So these are, I sorted them by the option volume. I mean, the market, based on volume. So the highest was the semi-bear 3x, 46 million. And so just a food for thought. That's our squeeze. Our scan of the week, I wanted to do the LRC. I know many of you enjoy that. I love it because, again, mathematically it makes sense. So you can do this in your Thinkorswim scan, and basically it is a pre-study already pre-built. So you can just go to the TTM LRC scan, use the close, or you can use Mark. So either one. But what I want to see if there's any bargains I can hunt. I know the markets are down. It will make more sense maybe look at the outside, like the top of the things for the shorting it. I thought, well, what if the markets went and then bounced back? They held their support. So I went with the below the 2 standard deviation, and we came out with these 9. And I usually sort them with the Sizzle index. So that's, you got the Morgan Stanley of the world, you got Southern Company, so IBM. Anyway, so these are LRC, just give you 9 of them. You can study them, especially we have Monday off. So just a food for thought. Last but not least, we still got some really good earnings coming up for next week, such as, some people, Teladoc, which was one of the biggest holdings of Cathie Wood. You got some retailers and, and staples. And so we got Home Depot, Macy's. Now Home Depot continues with, then we got Lowe's coming up right after that. We have eBay and Lemonade in a fintech. There's quite few interesting things. The biggest one I would watch this week, I would love to hear what they have to say, is the Alibaba, what's going on. So we got Intuit, but Zscaler. So this is what's coming up. These are, if you want to play the volatility. So here we got Teladoc, we got Fubo, Lowe's, again, Overstock. This is what I would watch. Alibaba, Block, Home Depot, Macy's, Moderna, and Coinbase. Okay, thank you very much. Thank you for your attention. I hope it was informative. With that in mind, I can open up for questions, Sean, so we can stop